Hello everybody, it's Yashar here, back again with another video. And in this video, I'm going to summarize the Canadian bank stocks earnings report and compare these reports for the 7 largest publicly traded banks in Canada. I divided these earnings report into 5 categories of great, good, okay, bad, and disaster depending on the numbers and financial figures reported in the earnings of each bank. I personally invested in 2 Canadian banks at the moment, TD Bank and EQ Bank. And my wife is also invested in Bank of Nova Scotia, and that's why I read the earnings report of Canadian banks carefully and follow their news. If you want to see the detailed valuation analysis of each of these companies, each of these banks, you can watch my previous video on valuation of Canadian bank stocks, which I will leave a link to that video in the description box below. I will start with EQ Bank as the 7th largest Canadian bank with a market cap of 2.3 billion Canadian dollar. I think their earnings report was actually great. I already covered the earnings report of EQ Bank in detail in a separate video, so if you want to know all the details, the link for that video is in the description box below. And overall, they reported great growth and profitability numbers in pretty much all aspects of their business. Their adjusted diluted earnings per share was up 7% quarter over quarter and 9% year over year. Their assets under management was up 47% year over year. Number of customers was up 23%. Deposits were up 14% year over year. They also increased their dividend yet again by 6% quarter over quarter, which is absolutely insane. It's not year over year, it's quarter over quarter. They basically continue to increase the dividend every single quarter by 6 or 7%. One of the important profitability metrics when valuating bank stocks is return on equity. EQ Bank adjusted return on equity was 15.9% in Q4, which is pretty good. Another important profitability parameter that I like to look at for bank stocks is net interest margin, which is an indicator that measures the net interest income a financial firm generates from credit products like loans and mortgages. In summary, a positive net interest margin suggests that a bank operates with positive profits, while a negative figure implies investment inefficiency. Their adjusted net interest margin, or NIM, was 1.87% in this quarter, which is a good margin for a growing business like EQ Bank, which wants to offer competitive rates to customers. And their net interest income was up 40% year over year in this quarter. In terms of the risk management, common equity ratio is an important parameter. CET1 ratio, or common equity tier 1 ratio, basically compares a bank capital against its risk-weighted assets to determine its ability to withstand financial distress. The regulators recently increased the minimum common equity tier 1 or CET1 ratio for banks in Canada, and now, effective February 2023, the common equity ratio requirement is set to be 11%, up from 10.5%. EQ Bank CET1 ratio is at 13.7% at the moment, which is well above the minimum ratio that regulators set, which means they are well capitalized for potential losses at the moment. All in all, solid numbers across the board for EQ Bank, and I think EQ Bank earnings report was definitely great, and it deserved to be in the top of the list here. The second earnings report that I'm going to look into is the earnings report of National Bank. National Bank is the 6th largest Canadian bank with a market cap of almost 34 billion Canadian dollar, and I think their earnings report was actually okay. 3 important metrics in the highlights of their earnings report here. Diluted earnings per share was down 6% year over year. Return on equity was also down from 21.9% to 17.9%. It's still a very good number, but it's down year over year. And their common equity tier 1 ratio was down from 12.7% to 12.6%. The main reason that their diluted EPS and net income was lower this year was simply because of higher provisions for credit losses, which they mentioned is reflecting a deterioration in macroeconomic factors. So the reduction was simply because of increasing their capital ratio to manage their risks. One thing I liked in this report was that their net interest margin was up to 2.19% in this quarter, which is great. I like National Bank, and I think they still have a lot of room to grow and expand their business in future. Overall, not really an amazing report with lots of exciting growth numbers, but it wasn't bad either. So I think it's fair to say that earnings report of National Bank was pretty okay in this quarter. CIBC is the fifth largest Canadian bank with a market cap of 56 billion Canadian dollar, and it is the next bank that I will recap their earnings here. And I think their earnings report was actually a disaster. They increased their provisions for credit losses on their loans, like other banks in Canada, which caused reduced earnings for them in this quarter. Three main metrics: adjusted EPS was down 5% year over year, adjusted return on equity was down 15.5% year over year, and their common equity tier 1 ratio was down 11.6% year over year. As you can see, CIBC has a lower common equity ratio than National Bank and EQ Bank, and if regulators basically want to increase the minimum capital ratio in the future, CIBC has to put more liquidity aside to increase this ratio, which will lead to even weaker EPS and income numbers in the coming quarters. They also reported a weak net interest margin of 1.33%, which is the lowest margin between all the Canadian banks as far as I remember. Their cash and deposits were also down year over year, and overall, I don't really see any good number here in this report. I think this was another disastrous earnings report for CIBC, and overall, I don't really think they are in a good shape at the moment. Bank of Nova Scotia is the fourth largest Canadian bank with a market cap of 81 billion Canadian dollar, and I think their earnings report was also a disaster. Their diluted EPS was down year over year by almost 13%. They increased their provision for credit losses on their loans like other Canadian banks, which caused reduced earnings for this quarter. Their adjusted return on equity is at 13.4%, which I think is one of the lowest numbers between all the Canadian banks at the moment. Their common equity tier 1 ratio is 11.1%. Similar to CIBC, they may have to raise this ratio if economic conditions get worse in the future quarters. The only metric that they can get a pass in this earnings report is their net interest margin, which is at 2.11% at the moment. The international banking sector in Latin America is really underperformed compared to other sectors of their business. I think they should really think about their strategy with their branches and investment in Latin America moving forward. I believe we can all agree that Bank of Nova Scotia earnings report was a disaster. The next earnings report that I cover today is related to Bank of Montreal, which is the third largest Canadian bank with a market cap of 90 billion Canadian dollar. I think their earnings report was actually okay. It wasn't terrible like CIBC and Bank of Nova Scotia, but it wasn't as good as EQ Bank. They increased their provision for credit losses on their loans like other banks, which caused reduced earnings for this quarter. Their adjusted diluted EPS was down year over year by almost 17%. Their adjusted return on equity was also down to 13.4%. Their net interest margin was flat at 1.62%, which is not really amazing. And their common equity tier 1 ratio is at 18.2%, which is pretty good. It's pretty safe. They also see a growth in their deposits, assets under management, and overall assets of the company, which are all good indicators. Overall, some good numbers here, some okay numbers, and some not so good numbers in this report, which means Bank of Montreal earnings report was an overall okay. The next earnings report that I will look into is earnings report of TD Bank. TD is the second largest Canadian bank with a huge market cap of 161 billion Canadian dollar. And I think their earnings report was actually good. They had a few one-time expenses during this quarter, including the settlement of a Stanford litigation for almost $1.6 billion and mitigations of their First Horizon acquisition for almost $876 million. But on an adjusted basis, they actually were able to grow their EPS by almost 8%. So if we don't consider these one-time payments, one-time expenses, they were able to grow their EPS. They also increased their provision for credit losses on their loans, like other Canadian banks, but despite increasing the provision for credit losses, they were able to deliver relatively good results in this quarter. Their adjusted return on equity is at 16.1%, which is up year over year, and that is a great number. Their common equity tier 1 ratio is at 15.5%, which is very good. And finally, their net interest margin is at 2.8%, which is absolutely amazing. I think it's the best NIM between all Canadian banks. They also increased their deposits, cash, and revenue during this quarter, which all in all means this was a good earnings report for TD Bank. The only reason I don't assign a grade to this report was those one-time settlements numbers, those one-time settlement expenses that TD had to pay out. But other than that, this is a great earnings report for TD. The last earnings report that I cover today is related to Royal Bank, which is the largest Canadian bank and Canadian company with a market cap of 188 billion Canadian dollar. And I think their earnings report was also good. They increased their provision for credit losses by 7 basis points and allowance for credit losses by 3 basis points, like other Canadian banks, but overall, their earnings was fine this quarter. Their adjusted diluted EPS was up 7% year over year. Return on equity was slightly down to 16.8% from 17.3%, and their common equity tier 1 ratio was at 12.7%. Their net interest margin, however, is at 1.47%, which is maybe not so great. Their total revenue, assets, deposits, cash, and assets under management was all up year over year, which shows the quality of Royal Bank business. Overall, I think this was a good earnings report for Royal Bank, but it wasn't an amazing earnings report. There you are, guys. I hope you enjoyed the video. And if you enjoyed the video and my coverage of earnings report of Canadian banks and overall Canadian stocks, consider subscribing to the channel to see similar videos. Thank you for watching, and I hope to see you guys in the next video. Farewell.